It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. It is Jill on Money. This is the program that takes the mystery out of your financial life. I am Jill Schlesinger. I am joined by Mark Talercio, the best executive producer in the world. Before we got into the air, he was complaining to me that he was out of shape. You know what's funny? When you get as old as I am, Mark, you'll find that even if you are in shape, you can have little injuries. I didn't mention this, but I had a dog walking little injury. Yeah, another dog walking injury. Whereas you see that like normal people would just walk and be fine. My crazy terriers went nuts. One was off leash for a little bit. She got into a place where I wasn't so psyched. I ran to get her and I pulled my hamstring a little bit. It stinks to get old. But the alternative, not great. So hope that you are feeling well. Hope that you are feeling in shape. I'm trying to cajole Mark into getting some Bowflex dumbbells, the adjustable dumbbells, which are fantastic, if I may say. I love them. They're a little clunky, Mark. That's the only thing. You know what I mean by that? Like they're not like slim dumbbells because they have so much more weight on them. So it is a little bit clunkier. Yeah, a little bulky, but well worth it for small apartment living. Show is not brought to you by Bowflex, by the way. And we are, of course, delighted if Bowflex would like to advertise, but they have nothing to do with this show. Let me tell you who has something to do with this show. LifeLock. We are presented by LifeLock. LifeLock. Let us help protect your identity. I keep hearing some identity theft things around these unemployment benefit 1099-G forms. Just be careful, gang. You get stuff, you don't recognize it. Check out the information. Be clear what is yours, what is not. Just don't turn your information over to anyone. Be smart. Okay? Good. All right. If you have a financial question, anything at all, could be identity theft, could be investments, could be taxes, could be lots of different things, send us an email. Ask Jill at jillonmoney.com. Ask Jill at jillonmoney.com. And if you want to come on the air with us, don't forget, we'd love to have you. Just say, I want to come on the air. All right. Hi, Mark and Jill. Sean writes, I recently sold some property that I inherited and the net proceeds were around $800,000. I've used $200,000 of this to place a down payment on a $1 million home that is currently being built in a brand new subdivision. I plan to use another $500,000 from the remaining inheritance to apply towards the purchase of the home and financing the rest. The balance of the home is due upon completion. This is going to be a timing issue, okay? The developer tells me homes are projected to be completed in around 10 months to a year. Although, with current supply issues caused by the pandemic, it may likely be closer to 12 to 15 months. Boy, if you're lucky, I'll tell you that much. While I'm waiting for my new home to be built, what should I be doing with the roughly $500,000 that I intend to use? Do I just keep it in a high-yield savings account and earn next to nothing? Do I risk putting it into a 1-year CD, or would a 6 to 9 month CD be safer? Are there better options for holding this money in the short term? Thanks to your advice on the show over the years, I'm very comfortable with my emergency fund and my retirement accounts. Best regards, short-term saver. All right, short-term saver, also known as Sean. I think just do a high yield money market or savings account. I don't even think you're going to get much by locking it into a 6, 9 or 1-year CD. But I think that just, having that available to you is probably going to be smartest. I just don't think you're going to get enough extra oomph. You can keep an eye out on depositaccounts.com. But still, I don't know. I think you're probably just better off keeping it liquid, and it's annoying, and I get that, but you don't have a lot of choices. What do you think about spending all the money, by the way, Mark, and basically not knowing anything else about him? How do you feel about that? Mark's like, yeah, I kind of thought that was going to be, yeah. I don't know. Like, that's to me, I sure wish you had been able to save a little. Maybe you got a whole bunch of money saved already, right? You said you're comfortable. So maybe there's tons of money elsewhere. I just really have the sense that for many people, like this happened to a friend of mine recently. She was able to sell a house for a big pop, like a very big profit. And we were talking about where she was going to go next. And she looked at another home and she said, I can't believe this because I'm the type of person who would just normally take all of my money and plow it into the next. She goes, but you really have had an impact on me. I said, how so? She goes, because you make me crazy, which is exactly what you make me crazy is what she said. And I said, what does that mean? She says, well, I sold my house for $2 million. And now I absolutely positively want to limit my next home to 1 million. I said, that's why I love you. And that's why I'm glad I made you crazy. I'm happy about that. I just like having cash. You know that, Mark. It's my favorite asset class or liquid assets. Let me say that. Okay. Suzanne says, I listen to you all the time and I enjoy learning from you. My husband and I are both 57. We have an inherited IRA, a rollover IRA, and 401ks totaling about 1.1 million. Realize they are terribly balanced with 95 to 98% in stocks. We would like to rebalance and end up with about 50% in stocks. Didn't know if we can just move large amounts from the current funds to bond funds or if there's a special way to do this slowly, some each month. Do you have any suggestions on a good bond fund? Well, here's the deal, Suzanne. I would just go ahead and do it because the last thing you want to happen is to be caught with a downturn in the market without you being protected. Why don't you follow up with me and tell me where these funds are held? And then we can try to give you some suggestions about bond funds. In general, the intermediate term bond funds at most of the major houses, which would be where I think you probably are if you're self-managing, whether it's Fidelity or Vanguard or T. Rowe Price, keep it like in those types of accounts. These are, again, retirement accounts. There's no tax impact of you moving funds around, and there's no tax impact in being in a bond fund that creates income for you. So, but do follow up. Let us know where these accounts are held, and good for you that you are looking around. I mean, listen, it's been fantastic that you have been able to capture the upside in the market. Now it's time to lock in those gains and secure your future. And maybe you don't have to go 50-50, maybe 60-40 is enough, but follow up with us, give us a holler, let us know. And that would be fantastic. All right, you are listening to Jill on Money. You know what you can do during the break? You can sign up for our free weekly newsletter. Mark, how many people we have on the newsletter list right now? Oh my God. And you know I want that round number by the end of the year. I need 4,000 more subscribers to get to a big fat round number. That round number will be held in secret between me and Mark. But I need 4,000 of you to sign up for the free weekly newsletter. Okay? So go ahead and do it at JillOnMoney.com. Okay, when we return, more of your questions. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. And we are sponsored by Facet Wealth. Here's the cool thing about Facet Wealth. This is financial planning that is really accessible to loads of different kinds of people. Facet Wealth provides flat fee, conflict-free planning. And all that planning and all that work comes from CFPs, Certified Financial Planners. They do goal-based financial planning. You get a dedicated CFP, not someone from a call center. There are no wealth or account minimum, something that I think is really important for many of the folks listening out there. I know you guys are always saying, I don't want to have a certain amount of money to get financial advice. Well, then go check out Facet Wealth, facetwealth.com. That's where you can get information. And if you'd like some help with your financial planning before you go to Facet Wealth, give us a holler. Ask Jill at jillonmoney.com. And don't forget to tell us if you want to come on the air with us. That is what William did. William is on the line from New Jersey. What can we do for you?
Little info about myself. I'm currently married. I make $82,000 a year. My spouse makes $62,000 a year. However, I actually have some interesting incomes that kind of makes this question a little difficult for me. One of the income is a per diem. So every day I work on my job, I'm getting a specific amount, which is about $185 a day.
Mm-hmm.
And at the end of the year, I typically get a bonus. So that gets my compensation just for myself up to about $176,000.
176 for you, just you.
Just me. That's correct.
Wow.
Yep. And then my spouse is still at $62,000 a year.
So that trajectory where, you have a base, but then you also have per diem and bonus and all that. You're a W-2 employee though, right? In other words, you're an employee, not self-employed.
That is correct. Yes.
Okay, got it. So now it's not so simple, as you say, because, you make almost 240 grand a year together. And that's kind of a good chunk of money. Tell us some more about what else is going on.
Sure. So, like I said, my spouse makes $62,000 a year, but she's a resident physician. So in about another 2 years, so maybe 2023, that income is going to go up as well, approximately maybe $250,000 a year.
Oh, boy. I mean, great. I mean, I shouldn't have said that way. Hey, that's awesome. I mean, really, it is completely awesome. And you're going to make a lot of money. You'll pay a lot of taxes. So that's that. But let me ask you a question about the current game plan here. Let's just talk about the next 2 years. Because is it likely that you're going to make about this amount of money together, this 240-ish? Or do you think it's going to go up in the next couple of years also? In other words, I'm just trying to figure out whether I think you're going to stay in. Are you going to probably stay in the 24% tax bracket until she becomes a full-fledged attending physician?
Yes.
Okay. And what are you doing for retirement?
Right now, we both contribute to Roth IRAs outside of work, so we have to do a backdoor Roth contribution. Through work, she does about 10% through a Roth 401k. And I'm currently, and I've been doing this for the past 2 years, that's why I have this question, is I've been doing about 18% on my Roth 401k.
You both are using Roths through work, right?
Roths through work, that is correct, yes.
Okay. I like that as a game plan. I think that is the right decision, at least for the next 2 years, for sure. Like, there's no doubt in my mind that you should definitely do that. Okay, so smart, great, well done. So let's pretend it's 2023. Oh, and how old are you guys?
So I am 29, going to be 30. My wife is 26.
You're so young and you're making so much money. God bless you. Tell me the first few years while she's a doctor, like, what do you think your income's going to be total? Like, I just want to look forward in like 5 years from now. What do we think your total income is going to be?
I think 5 years from now, we're looking at the mid 300s or a little bit above that, but to be conservative, mid 300s.
Because that does pop you up into the 32% bracket. And at that point, I think we have to make a different kind of a decision, which is, I mean, we'll know a lot more about the tax code, obviously, but I don't know whether or not it's going to make sense then to be using the Roth as much I mean, I'm sort of inclined to say yes. The reason is that even if you are in the 32% tax bracket, it might be nice to have some of this money that's taxed already. And is she going to be the kind of doctor that makes more and more money? Or do you think that, I don't know, a lot of doctors I know, they complain they don't make any money, but they do make more money sort of in their 40s than in their 30s. So is that the kind of doctor that your wife is going to be, you think should make more money later on?
I think it's going to be a slow progression. I think it's internal medicine, so it's going to be more of a base and slow progression type compensation.
And what about you for your own career? Do you feel like you have a lot of upside yourself?
I do have a lot of upside. And one thing the reason why I also wanted to ask this question was the wild card out of my compensation is my per diem, right? So the reason why I get that per diem is because I'm currently working in New Jersey versus where I got hired for my role, which is Kansas City. By relocating, I get compensated to adjust for cost of living, and so that is a wild card that might not be there in the future.
Mm-hmm.
As long as I'm in New Jersey, that is going to be somewhat of a factor. Really, I know the answer, because I'm an engineer. I feel like it makes sense to contribute to the Roth. But when I'm looking at it from a cash flow perspective and how much tax I pay per year, I'm trying to understand, does it make sense to actually have any form of, tax deductible contribution just to reduce the taxes? And then especially, like you said, when we're making, the higher income in the future.
Well, I'll tell you for the next 2 years, definitely the if you run the analysis, you'll be like, oh my God, it's a no brainer. And I know that you know that because engineers are very good at that. However, you're also a human being, which is too bad for you because what you do is you look at your tax bill and it makes you nauseous and you're in a high tax state. You guys have any kids yet or not?
No kids yet, no.
Okay. You own a home?
Yes, we own a home, yes.
All right. But it's not that great because you've got the state and local tax cap at 10,000. So you're not getting such a great bang for your buck. That being said, I know that as long as you're in the 24% tax bracket, we're going Roth all the way. I think we just need to figure out, and we'll be here for you, that when it's 2023, we really need to then say, let's see where the tax rates are. Let's see what's going on. Let's see if it makes sense. And we won't know that. And so I'm taking you off the hook for freaking out about 2023 right now. You're doing a great job. You're putting away a lot of money. And that's exactly what you should be doing. Do you have an emergency reserve fund that's just, in case you decide you're sick of New Jersey and you want to, go back to Kansas City?
Yes, yes. So my wife and I, we have about a 6 month emergency fund, and we actually also save after tax in the brokerage account as well. So I'm one of those people that have trying to retire as early as possible. So I'm taking advantage of everything that I can take advantage to invest right now. So
Listen, she has to go to school for 100 years and do training for 100 years. And so she's going to be working for a while. She's going to be like, I didn't do all that training to retire. You may choose that, but just be nice to her while she's supporting you. I think you're in very good shape. Let's keep doing the Roth and let's stay in touch so that we can help you out and, as things change. And by the way, if we get some sort of change in the tax code, just shoot us a note so we might make a different decision. If you would like to join us on the air, all you need to do is send us an email. Ask Jill at jillonmoney.com. Or if you're on our website, if you're on the jillonmoney.com website, we've got a contact button. Just click on it and you'll send us your question, but say, I want to come on the air with you. And Mark does the rest. Okay, we'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back. It's Jill on Money. We are trying to take the mystery out of your financial life one person at a time. Next up, we have John, who's on the line from Wisconsin. Hi, John. What can we do for you?
Hi, Jill. Hi, Mark. My question is around Roth IRAs. My wife and I have been contributing to Roth IRAs for several years now, and we are in the high income or higher income where we have to do the backdoor Roth. And one of the confusion points I have is I've heard in past discussions on your show that you have to have everything in Roth IRAs, and that's not the situation we have. We have 401ks, we have Roth, or we have rollovers, we have traditional IRAs, we have Roth accounts. I have a taxable account, and most of that is all in Fidelity. So I guess my confusion is, do I have to convert everything that's a traditional to a Roth to have a Roth?
Okay. So it's very confusing, which is why I had to go back to my friend, Ed Slott, who we've had on the program. And he's the one who first raised the red flag to me about the IRA to Roth IRA conversion process and the pro rata rule. Now, here's the deal. This is like kind of a weird thing, but for the purposes of even a backdoor, all of your IRAs are treated as one big IRA account. So even if, for those of you listening, if you have an old SEP or a simple IRA, it's all like one big thing, okay? Because these are all treated as one account, you're not supposed to, you generally can't segregate after-tax contributions. And so what the IRS does is they say, well, some of this money is pre-tax funds and some is after-tax funds. And this is what essentially is the pro rata rule. When you have these old legacy accounts, it's not to say that they're going to come after you and beat you down. Because, I mean, I don't know if the IRS can barely keep up with the things they have to do on their, like bigger problems. But when you have these old accounts, we like to kind of clean them up a little bit. So let's see the best way that we can clean them up for you guys without causing a huge hardship. So number one, how much money do you guys make together?
We combine about $200,000. That's for myself, and about $150,000, and my wife makes about $50,000.
Okay, great. Is this the only retirement planning you're doing, or do you have other retirement accounts that you are contributing to as well?
No, everything we have is in Fidelity.
Okay. And you don't have 401ks, I mean?
Oh, I'm sorry. Yes, those are all in Fidelity as well. But so my wife and I each have a 401k that we contribute to, and both of those are Roth as well.
So
they were traditional, and then both companies allowed you to start doing Roth. So I'd say the majority of it, each account is still a traditional, but all the preceding
new money
for the last 5 years have all been Roth.
Oh, that's good. This makes it a lot easier. Okay. How much money is in traditional IRAs that's outstanding right now for you guys? Not, again, that old, you said you had a couple of old accounts. How much money is in each of those accounts?
Yep. So we have two accounts each, or one account each, excuse me. And those are rollover. One's a rollover, one's a traditional IRA, both combined to 81. And then we have our separate Roths that combine to 300.
Okay, wait. How much was the rollover? Because there's going to be an easy conversation about that one. How much is in the rollover?
40, 50,000.
40 or 50,000. Is that yours or your wife's?
My wife's.
Okay. So the easiest thing to do for her is you take that rollover and she rolls it back into her current traditional 401k and make that go away.
Okay.
Just pop it into the traditional. And there's really no downside. You're in Fidelity, right? You got a lot of great choices inside of these accounts. It's fine. Now, tell me about this traditional IRA that you have. How much is in there?
25, 30,000.
How much cash do you have on hand?
50,000. Part of that would be our emergency fund. And part of that is just, I like a nice cash cushion.
Okay. So ideally, what I would have you do is I would have you convert what is left in that old traditional IRA that you have. You're not in a huge tax bracket. I mean, you basically, when you said you make $200,000 in income together, is that before or after you actually make your retirement contribution? Is that your gross, or is that what looks like your bottom right-hand corner of your tax return?
No, that's about gross.
So, and are you both maxing out your retirement accounts at work?
We are. Yep. Yeah. We've done a zero-based budget for many, many years now, and we every dollar has a name, if you will, and so we pay ourselves first.
Okay, good. This is what I think you should do. I think that you would have to pay the tax due on this 25 or 30 grand. Okay, and in the traditional, but if you're both, you're both putting this 19.5 into, how old are you? I'm sorry, I missed that.
I'm 40 and my wife is 36.
See, you sounded very young. I was presuming you were under the age of 50. You guys, your top bracket is 22%.
Mm-hmm.
And so there's two choices that you can make right now. One is that you say, I'm going to convert all of this traditional IRA money. I'm going to add 25 or 30 grand to my top line. I'm going to have to pay tax on it. It'll be at the 24, the 22% tax bracket, whatever. Some of it will be in each bracket. And I'm just going to make the problem go away to the IRS. The other idea is that you can just convert the amount that will keep you within that 22% tax bracket, convert that amount, and then maybe not for, did you already do your Roth conversion for this year?
No, we have not.
I don't know if I'd do it for this year. I don't know. I feel like there's a red flag. Mark, do you think that it raises a red flag to keep doing it? Yeah, I think that what we would rather you do is not do the conversion for this year and wait, convert your traditional IRA. Next year, you can resume everything. So then we don't have a traditional IRA in your name. Your wife's rollover goes back into her traditional 401k at work. And now next year, you start with the Roth, you do the backdoor Roth and start from the beginning, and you'll be in great shape. And I think that works. But the fact that you have this old money sticking around is a bit of it could become a problem. Again, I'm not saying it will be, but I think that it's really important that we just clean it up just in case.
This really helps because I've been thinking about doing that already, and you're just sealing the deal.
Okay, if you want to come on the air with us, and you can tell, I just like it when you guys are on the air. It's so engaging. You're so awesome and brave, and you can always change your name if you don't really want anyone to know who you are. Give us a holler. Ask Jill at jillonmoney.com. That is our email address. Mark will do the rest. He'll take care of you. Really cool. And you get to hear his voice. So what's better than that? Okay, we'll be right back.
If you've missed any part of the show or want to check out a past show, go to jillonmoney.com for more great personal finance content.
You're back. It's Jill on Money, and we are here answering your financial questions, whatever they may be. And it can range from, you've got a question about financing kids' college, maybe you've got a question about restructuring your own debt, maybe it's a portfolio question, a retirement question. I don't care. Mark and I just like all different kinds of folks. We recently got a guy who was a Bitcoin millionaire. Actually, was it Bitcoin or Ethereum, Mark? I can't remember what he owned. I think it was Ethereum also. Anyway, let's say call him a crypto millionaire. That was a first. It was awesome. So if you're lucky enough to be a millionaire, crypto or otherwise, we want to hear from you. If you are just starting out, we want to hear from you. It doesn't matter. Whatever situation you are in, we would really like to help you out. Okay? So what you need to do, send us an email. Ask Jill at jillonmoney.com. Okay, that's what Marcia did. And Marcia writes, I'm so glad I discovered your podcast. You've kept me company on many of my lengthy COVID-19 walks. Just a little parenthetical here, gang. You're listening to our radio show. We have a sister broadcast that's also called Jill on Money, and it is a podcast. How cool is that? All you need to do if you want to subscribe to that and you want to listen to us every single day when you take your walks or do whatever you're doing around the house, just go to our website, jillonmoney.com, and there you will be able to subscribe to the pod. Very easy. Okay. Now, Marcia goes on to write, I have an event planning business, so unsurprisingly, my income is substantially lower than in the past, but I still have a few $100s a month to stash away. How great is that? I'd like to keep this investment separate from my SEP IRA. That's a brokerage account. I'd like your thoughts on what I should do with it. I expect you'll say put it in a Roth. See, I've been listening, but I'd like to know specifically what type of instruments to consider. Okay, here's the situation. Marcia's husband is 64, and he's going to retire from his job in 3 years. He's going to consult part-time at that point. He currently makes about $170,000. Marcia says, I'm 59 and a half and will hopefully wind down my workload a bit when my husband retires, but I plan to keep working until I'm 67. Wow. My income was $80,000 to $100,000, but I'll be lucky to make 25 or 30 this year. And I would be surprised if I were able to get back to the $100,000 that I was earning before I retire. Well, you never know. Things could change on you on that one. Okay, here's the assets. $875,000 in husband's 401k, $290,000 in her SEP IRA, $50,000 in a tax-free municipal bond fund, $100,000 in cash. We want to access these last two items because in a few years we plan to be moving. Okay. We own our home free and clear right now. It's worth $725,000. It is a single story, but on a very steep lot. The cash will keep the most advantageous transaction and financing options available to us, potentially by being able to make a large deposit with an offer while our house is on the market. I'm happy to get your thoughts. Thank you, Marcia. Well, first of all, I want to look at this for your IRA, your Roth IRA plans. You got to be a little bit careful just in terms of whether you could create a Roth IRA. You're kind of close because if your husband makes 170, maybe he puts in the maximum into his retirement account. That brings his income down. So that would be good. And just remember that the Roth IRA phase out for contributions begins at $198,000 for married filing jointly. So just be careful, like make sure that he's putting in that $26,000 pre-tax, and that brings you down enough so that you could qualify. Okay, now, in terms of what you should put inside of the Roth, what exactly? She says specifically what type of instruments to consider. Specifically, how about this? How about that you look to an index fund? I always like to consider the idea that your Roth money is the last money that you will access down the line. So you should basically think of this as your most aggressive investment, because you have the longest period of time before you need it. In that case, then you might just say, I want to own an extended market index. I want to put in just like really roll the dice. Maybe in this, for this particular $7,000 contribution that you would $6,000 because it's the regular Roth contribution limit, $1,000 because you're over the age of 50. So for this $7,000, maybe you say I'm going to put $6,000 in the U.S. stock market index and $1,000 in an international index. Or maybe you're going to, you can make it all stocks, and you can really roll the dice. Maybe you put a little bit in a small stock, a little bit in a big stock, and a little bit in international. But that's what I would do. I wouldn't bother putting a bond in here because you have bonds, and I would also be a little bit careful on the transaction that you are describing, because although I like the idea of optionality, I don't love the idea that you would be looking to buy something before you sold your house. I like to sell first and then buy. That's just me. So hopefully that helps. And we thank you so much for weighing in with that question. If you, like Marcia, have questions about retirement, investments, whatever you got, just let us know. The email address is askjill@jillonmoney.com. askjill@jillonmoney.com. We'll be right back. You're back. It's Jill on Money. It's May. It's so exciting. I'm so over April. I completely thought that April was like the longest month of the year, even though it's not. Okay? I hated April. Just want to say that. If you've got a financial question, give us a holler. Ask Jill at jillonmoney.com. David writes, which is better to fund, a 401k after tax or a 401k Roth account? In general, I would just use the 401k Roth. Is there any reason to do the after tax account, Mark, if you have the choice of both? I don't think so either. Not in our book. The mega backdoor Roth sometimes requires people to go into an after tax and then convert it over to a Roth. But I don't think that's what you're asking. I think you're saying you have the choice of using after tax or a Roth. I would much prefer it be Roth straight up. And remember, gang, one of the other really cool opportunities when you have a Roth 401k at work is you're not subject to the phase out rules for contributions. So again, if you are single or head of household and you make more than $140,000, you don't get to use a Roth, but you do get to use a Roth 401k. So the IRA has those phase out limits, but the 401k does not. So I'm saying let's do Roth, go for the Roth. And certainly if there's a follow up or there's something else that we're missing, feel free to let us know. Okay, Dave? All right, you're listening to Jill on Money. And when we return, we've got a special guest, someone who's got a real long-term experience of managing money and being in the business. It's always fun to have these kinds of people join us. It feels like a little wisdom that we could get plunked into our laps. So stay tuned. It's Jill on Money. When we return, we're going to talk a little bit about some of the lessons that a long-time Wall Street insider can provide us. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
You're back. It's Jill on Money. And we are so happy that you are joining us for our second hour of the program. We are broadcasting from the Capital One Bank virtual studios. Capital One, this is banking reimagined. What's in your wallet? Mark, am I going to be the last person to actually use cash in the world? Is that going to be me? Am I going to be that old fart? Like, I just went into my little sandwich shop across the street, and they really don't want you to use a credit card or Apple Pay because there's a surcharge on it. So they give you a discount of 3.5% if you don't use a card and you use cash. All right, cash in a bodega, but we may be the only people who are doing that. All right. Hey, listen, I want to get to our guest. His name is Eric Gleacher. He is a really long-time legend on Wall Street. He wrote a book called Risk, Reward, Repeat, How I Succeeded and How You Can Too. So let's get right into that and find out about this guy's background before we get to the kind of juicy stuff, Lehman Brothers. Here is our interview with Eric Gleacher. I want to go back a little bit because the most interesting, is just sad to say because I do love all the different stories in your book, but the most interesting aspect of who you are to me at first blush was the fact that you were a U.S. Marine infantry officer. So can you talk about getting involved in the military and what was going on in the universe when that happened? Did you get drafted? Did you enlist?
Well, it's interesting you would say that's the most interesting part, Jill, because of all the things that I learned that shaped my life, it was those 3.5 years that I was a Marine infantry officer. So I graduated from college in the early 60s. And in those days, you got drafted unless you kept going to school. Even if you kept going to school, let's say you went to law school or business school or journalism school, once you were done with your student deferment, then you had to serve. So I decided that I would go ahead and do it. And for some reason, I can't tell you why, I decided that I wanted to do the most challenging thing I could do. And back in those days, there were 6-month reserve programs everywhere. There were lots of easy way outs. And for some reason, I decided didn't want to do that. And maybe it was because my father was in the Seabees during the Second World War in the Pacific, in the islands, building the airfields for the bombers to go to Tokyo and back. And I don't really know, but that's what I wanted to do. And I went in, and it was a formative experience. And that's why I opened the book with that experience of going to officer candidate school and what it was like, and then being put on active duty in the Fleet Marine Force, the challenges that posed for a 23-year-old who didn't know a lot, were huge. And I got through, and my self-confidence went through the roof for the first time in my life.
What do you mean the first time in your life? You weren't confident before then?
No, I don't think so.
Why not?
Well, I had an unusual childhood. I'm an only child. I never had any cousins. And we moved constantly after the war. I met my father when I was 7.
Whoa.
Yeah.
Hold on. Let's go back. What do you mean? Tell me that story.
Well, I was born in 1940, and Pearl Harbor was in December 1941. And after that, so by that time, I'm, 1.5 years old or so. And my father went in the military. For when the war was over, he worked for 2 years, one in Greece and one in Africa, before he came home. And why he did that, I've never been sure. He told me he did it because he could make a lot more money doing that, but he did it. And so by the time he came home, I was 7.
Would you say that because of the unusual circumstances of your early life, that it created some sense of wanting to achieve? Like, how did you get this achievement-oriented inner self? Or do you think that was almost bred in you from the military?
I've thought about that question many times. And I think the answer is, if one is born with that, if you're lucky, you have some of that in you. And in my case, because we moved around a lot, I didn't have any long-term friends. I never had a girlfriend until I was in college. I think I wanted to prove to other people that I was as worthy as they were. Maybe the combination, I was born with it a little bit, and then I wanted to show people I wasn't some second-class citizen. Had a lot of that motivation, there's no question.
It's amazing. So you come out of the military, and then what was your first job?
I was blessed with the fact that I was a really good kid golfer. I won all the junior tournaments around New York. I won the Connecticut Junior Championship. I played well in the Nationals. And so what I did during the summers was compete in golf. I never had a real job, is what I'm trying to say. In other words, I played competitive golf through college. I had golf scholarships. I decided that when I get out of the military, I wanted to get an MBA before I got a job.
Okay.
It's probably the same thing. It's, if you get a job as a college graduate, that's fine. And if you get a job when you have an MBA, it's even finer. Put yourself on a different level. Probably the same motivation that we just discussed about wanting to achieve. So the week after I got out of the military, I matriculated at the University of Chicago Business School, and I got an MBA before I had a real job. Ended up getting a job at Lehman Brothers in New York in investment banking, which I'd heard about. I borrowed money from the student loan fund, which you could do to move.
When you're at Lehman Brothers, just talk a little bit about who was in the regime there at the time you were there. There were still Lehmans who were running the firm, right?
When I got there in January of 1968, Bobby Lehman was still alive, but he was ill. And he died about a year later, turned it over to another fellow who also got sick. And a third fellow took control. And from that point on, it was tumultuous. It was a very aggressive environment. It was, you eat what you kill, and it was a competitive environment. But I stayed there for 15 and a half years.
Wow.
Yeah.
So when you're at Lehman Brothers, what are you doing there? Like, what's your life like there?
When I went there, I was the 15th person in what they called the industrial department. It was the corporate finance department. There was no M&A back then. M&A companies merged, but there were no professional M&A departments or M&A people. I was the 15th guy, the junior guy, so the other 14 wanted to, get me enslaved, in bondage, so I could do all their work and do their numbers, and it was that kind of thing. But there was some great aspects to the environment. It was totally unorganized. It was the opposite of some large firm with a hierarchy and all that. It was very unorganized, and you made your reputation. If you were good, if you did the work and you did it flawlessly, you didn't make mistakes, then more and more work came your way. And then eventually, once I got my feet on the ground, within the first year, I was out drumming up business. I wasn't afraid, and I went from there. I got to be a partner in 5 years, which was very quick.
Okay, we'll get back to our interview with Eric Gleacher in just a minute. Send us an email, askjill@jillonmoney.com, askjill@jillonmoney.com, and we'll help you out. Okay, we'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. This is the program that takes the mystery out of your financial life. It's also the show where money is not scary or boring. And every so often, we like to bring on a sort of a character, a storied character from our Rolodex. Mark, is that a word that really doesn't exist anymore? I don't think so. From our address book. And this one comes from friend of the pod, Spencer, who said to me, this guy's got a cool background. You should talk to him. So that we are interviewing Eric Gleacher. He is a lifelong Wall Streeter. He started his career at Lehman Brothers when Lehman Brothers was still kind of a cool place to work. And he then journeyed throughout his career to different organizations. So in many respects, the time that this guy was really in the heyday of Wall Street, right? 60s, 70s, 80s, there were tons of opportunities, specifically tons of opportunities if you were a white man. But when you decide to jump ship is kind of interesting to me. And he did make he made some bold moves. And so he recounts a lot of his career in a book that he's just written. Again, this is Eric Gleacher, and the name of his book is Risk, Reward, Repeat: How I Succeeded and How You Can Too. Look, not everyone can succeed in the same way, but there's kind of interesting lessons here. So as we get back into his story, we find out that, he worked at Lehman Brothers. Life's pretty good. But in this next part of the interview, we talk about how he jumped ship from Lehman Brothers into Morgan Stanley. And by the way, these two cultures of these two firms, very different, especially at that time. Here's more of our interview with Eric Gleacher. Things are moving dynamically, and you go from Lehman and then you go to Morgan, right?
Yeah, I mean, I left Lehman because basically the culture just got worse. I saw the M&A business being a huge business. And I had started the M&A department before that at Lehman. In a couple of years, it became a big success. And I kind of knew that I could go somewhere else that was significant. And I felt, that I had every penny I had earned was tied up in Lehman Capital, every penny. And I said, it's time to do something else. And so I called Bob Greenhill, who was running the investment banking at Morgan Stanley. He and I knew each other. We had been on the opposite sides of deals together. I had high respect for him. So I called him up on a Monday morning, told him that I was thinking of leaving and that if Morgan Stanley was interested, I'd be interested. He said, let's meet at 4:00 this afternoon. And we did. And 3 weeks later, I was a partner at Morgan Stanley.
So Marty Lipton is a storied deal attorney. Was he somebody that you met through just your various career permutations, or is he a friend from other ways? How?
No, I met him in business. I met him as I got more involved in mergers and acquisitions. And the short version is this: I decided in the mid '70s that Lehman had to organize itself in M&A because Morgan Stanley had, Goldman Sachs had, and they were going to companies and they were saying, we have specialized M&A operations. That's the way you need to do this business. So I went to Marty Lipton and I said, will you teach me about M&A? And he said, sure. And so every Saturday morning, I would go to his office in New York, and he and his wife at the time, who was a partner, we would take up a different aspect of M&A, and he taught me the business.
Wow. That's kind of cool. That's quite a tutorial, huh?
It was unbelievable. And of course, and we became personal friends. And of course, we did a lot of business together. They did tremendous business with Wachtell Lipton over my entire career. And so he's been a friend of mine since then, which is a long time.
I want to ask you a question about, you mentioned, when you were in these firms as partners, can you talk about the shift from partnership to publicly traded companies and how that really changed the dynamics of risk taking in the industry?
The firms went public because the more they got involved in trading securities, the more capital they needed. And the capital requirements that they were facing far exceeded what the individual partners could come up with. You were talking billions and billions of dollars because the trading volumes in the securities markets got very large. So they went public. They got the capital from the market. By and large, the good ones like Goldman Sachs and Morgan Stanley, they kept the partner culture. You still had to make partner. And even though instead of having 40 partners, 50 partners, you had 250 and then 450, they still were able to keep the partner culture going because of what it was.
But what is it fair to say, because I know a lot of those former partners, that they look at the amount of risk and leverage used by these companies today and say that if they were still partnerships, they would never in a million years take on the risk that they take on now?
True, but they couldn't have. They couldn't have done it for the reason I said, that they couldn't have had enough partners' money to do it. You're absolutely right, and they're right. We sold a business in Brazil, in Sao Paulo, called Garantia. And Garantia was a partnership with 19 partners, and it was always referred to as the Goldman Sachs of South America. And we sold them to Credit Suisse for $1,400,000,000. So it was a serious business. And the reason they sold was the majority of the 19 partners were men in their 50s and 60s. They had made $1 billion 2 years before we sold them, and then they lost most of it in the year before we sold them. So they had a dichotomy of interest, and the older partners wanted to sell and get their capital out. The younger partners didn't, and they sold. So that's what these former partners are telling you. But what I'm saying is to take the risks that they do today, they need the public markets because they have billions of dollars of capital. It's a different thing.
I don't love that, the dynamic. I really don't. I have to say, being around the business as long as I have been, and, look, you're a deal guy, so I get that, like, the deal aspects of this are very different. The amount of risk and the ability for these guys to cloak themselves in oh, yes, we have this wonderful culture. And then when things go wrong, they can dump it on the government and say oh, yeah, well, actually, we do need some of your money. We would like to get some help from you guys to bail us out of our bad decisions. But so be it. Let's move on. Why did you form your own investment bank after working at Morgan Stanley?
I wanted to do it.
Just like that. I just wanted to do it.
I wanted to see if I could do it. I had a wonderful period of my career at Morgan Stanley. I got nothing but great things to say about it. It was the heyday of M&A when Mike Milken was going after the business establishment companies. But I wanted to do it. I thought I could. And I figured I would make less money, which was totally wrong. And I just wanted to do it. And I did it.
And how long did you do that for?
23 years.
What was the impetus to shutting down?
Well, 2008 occurred. And as you said, all these firms were in trouble. And by the way, a lot of them, the better firms, they were in trouble because of what the bankruptcy of Lehman did to the financial system.
Mm-hmm.
It wasn't necessarily that they caused it. But anyway, we had the terrible financial crisis of '08. All the deals we were working on, and we had a bunch of them, all of them cratered. Blackstone paid $50 million to get out of one purchase that they were doing because they just didn't want to buy it. I mean, it was a tough time. I said, I'm 68 years old. I don't know what's going to happen to the world. I don't want to sign another 15-year lease. And so we sold the business to a small sales and trading operation that had been pursuing us for a couple of years, and eventually that combination didn't work. I got to the point where I didn't want to be the CEO. We hired somebody, and it turned out that the guy we hired had trouble executing the job, and I eventually retired. And then the firm was liquidated. Didn't have any debt. It had about $100 million in cash, and it was distributed to the shareholders.
We'll get back to our interview with Eric Gleacher in just a minute. So during the break, here's what you can do. Go to our website and be curious. Poke around. See what's there. We have so much information. We have the read tab, the listen tab, the watch tab. We've got resources. All that is right there for you. You can even buy my book, The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. Okay, we'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back. It's Jill on Money. And this is the show that attempts to take the mystery out of your financial life. One of the big questions that Mark and I field all of the time is a question around how to pick a financial advisor, how to pick the right firm. When do you do it on your own? When do you go to a robo-advisor, meaning the kind of the hybrid model of, say, using a online investment platform with a little side dish of financial advice. And, everyone's got different needs. I get it. And we certainly encourage you to check out all of your options. But if you are the kind of person who really thinks that you might benefit from receiving one-on-one financial advice, because you know what? Sometimes people don't want to do it with a robo-advisor. Sometimes they want someone who can hold your hand throughout the process. If that sounds like you, if that's the way you are, maybe you're the kind of person who likes to have a trainer, right? A coach, then check out our sponsor, Facet Wealth. You've heard Brent Weiss. He's the chief evangelist of Facet Wealth. You've heard him on our program before. And I really thought that when he was last on the program, we were talking about how people pick financial advisors. I do love the idea that because everyone who's giving advice at Facet Wealth is a certified financial planner, that they start with a goal-based planning from dedicated advisors. Meaning you get the same person every time. That's your advisor. But it's goal-based. It's not transaction-based. And as a result, that kind of planning work can be done for a flat fee without any conflicts. So that's kind of cool. We also want to mention that when we talk about financial advice and this kind of financial advice, it can often feel like it's out of reach because this type of advice has, in the past, has really been reserved for the wealthy. When I mean wealthy, I mean people who have at least a couple $1 million, maybe $1 million. Well, Facet Wealth, there are no minimums. There's no minimum on an account size, on your total wealth, on your earnings. It's essentially just planning for people who need help. Now, it does not mean that this is the perfect solution for you, but if it sounds pretty decent or it sounds intriguing, head over to facetwealth.com. Facetwealth.com. Okay, now we got to finish up our interview with Gleacher. I went crazy with that read. My goodness. So we are finishing up our conversation with Eric Gleacher. And in this part of the interview, we're talking about how millennials really are somewhat uncomfortable sometimes with the idea of risk and reward. Here is the conclusion of our interview with Eric Gleacher. Young people coming into financial services or any industry, you talk about risk, reward, repeat. What is your view of the millennial complaint that it's really hard to take a lot of risk if, number one, you don't come from money, and number two, you got a boatload of student debt hanging over you? What do you mean by risk when you talk to someone like that?
Well, I think they're wrong. I think if you don't come from money, it's easier to take risk. I think if you've grown up and you've gone to Dalton or Trinity or one of the elite schools, and you come from a comfortable zone of upbringing, and maybe when you're in your 20s, you got some money from your family. That's when it's hard to take risk. If you don't have anything and you're doing stuff, you're gonna be more inclined to go for it.
And what do you think about the idea? I mean, it must feel strange to you, a guy who worked his butt off, and you surrounded yourself in environments where people work their butts off. How do you make sense of this concept of, having some balance? Because there was another executive, a female executive, I was at in a big event, and from one of the firms, and she basically looked at the audience and said, there is no work-life balance. There is no work-life balance. You have to work your butt off, and you work, and you figure out how to make that balance work in your life. But you're not going to be able to spend as much time with your family if you're going to work this hard. Is that still the right model?
It is the model. There's no question that she's right. You're not going to be able to spend as much time with your family, but if it's the right balance for you and you're in your life, you're going to do a better job with your children. And they're still going to come out on top, in my opinion.
Do you have any advice for CEOs running these big banks right now? We just had the Archegos debacle about risk. And what is it that needs to happen now so that these firms have a better handle on what exactly is going on at other firms and where the risk lies?
You've heard of common sense, I assume.
I know, but it's sometimes suspended in bull markets.
Well, I mean, look at what I'm talking about. You got a guy who had a $44 million settlement with the SEC for insider trading violations. And if you notice, the people who really got hurt here were the banks, the second tier banks, who are hungry for business. Credit Suisse, Nomura. I don't know where Deutsche was, but those are the banks that take on the clients that usually the Morgan Stanleys and the Goldman Sachs don't take on. Now, they were in there, and somehow Morgan and Goldman sold out before everything was dumped. So it just may be that they do some things better. But when WeWork was in its prime, and they were supposedly going public for $47 billion, and it was just a mess. I just boggles my mind how JP Morgan was all over them and, taking them seriously. So sometimes this happens, and it's happened over and over through the years, and it'll happen again because these institutions, they want to make money, and sometimes they take chances that are, not in sync with the risk involved.
Well, at least this time they bailed themselves out because they were all having great quarters, except for, I don't know, did I read that? I think that Credit Suisse's loss is more than $4 billion on this deal. Unbelievable, isn't it?
I read that, $4.4 billion. No, that's not unbelievable when the guy is leveraged and, all of them have experienced big losses from time to time. Sometimes it's in fixed income. Sometimes they have a huge leveraged position and it goes wrong. I mean, they can lose that kind of money because they have enormous capital. But in this case, they're dealing with a guy that was leveraged to the moon. He'd had problems before. That's when the boss should say, I don't think we should really be in this.
Okay, that is it for our interview with Eric Gleacher. If you would like to check out his book, it's called Risk, Reward, Repeat, How I Succeeded and How You Can Too. You can get it wherever you buy books. And if you've got a question that is arising after listening to that interview, shoot us an email. Ask Jill at jillonmoney.com. We'll be right back.
If you've missed any part of a show or want to check out a past show, go to jillonmoney.com for more great personal finance content.
You're back. It's Jill on Money. And if you've got a financial question, a career question, a tax question, anything that is remotely associated with a dollar, anything, just give us a holler. Our email address is askjill@jillonmoney.com. askjill@jillonmoney.com. And if you're on our website, maybe you've gone to the jillonmoney.com website, which Mark is the webmaster of this bad girl, and it's fantastic. But if you're on the website, there's a contact button. It's the upper right-hand corner. Use it. So easy, right? Okay. Oh, Mark, I was wondering, is it time? We're going to have to take down, I think before this show airs, we will have done it. All of the coronavirus stuff. I think we got to take it down. Oh, after tax filing. No, I think we should do it after. Let's do it after tax filing. How about that? I feel like now I've just tempted fate. Oh, all right. I hope not. Anyway, jillonmoney.com. Okay. Let's get to some more questions. This is from Virginia, who listens to the daily podcast. Yay! And she says, I've never missed any daily podcast ever since last March. Wow. What a fan. Love that. Thank you very much, Virginia. Okay. She also says, please convey my thanks to Mark as well, since you and Mark help us understand financial matters. Okay. This is funny. Virginia lives in Virginia. I wonder how many people heard that. This is interesting, like a Venn diagram of the number of people named Virginia who live in Virginia. Anyway, Virginia has a question about converting traditional IRAs and rollover IRAs into a Roth. Okay, what do I need to pay taxes on? Okay, she says, I want to convert $100,000 to a Roth IRA. Then do I pay taxes on the current market value, which is $100,000, and the cost basis, which was $40,000? My income. All right, here's what the deal is. If it has not been taxed, if the money in a traditional IRA or a rollover IRA has not been taxed, there's no capital gain involved. This is all ordinary income. Okay? What that means is that whatever you earned previously, this amount that you convert, this $100,000, gets added. Let's pretend, I don't know whether you're single or married or what, but I'm going to make up some facts. Let's say that you are single and you earn $50,000 a year. If you were to convert the entire $100,000 at once, that would mean you have $150,000 of ordinary income, and you will be subject to the progressive tax rates associated with each of the brackets. So that means that you have a 10% when you pay up to just under $10,000, then the 12% from about $10,000 to $40,000, 22% from $40,000 to $86,000, and 24% on the amount from $86,376 up to your $150,000. So that's how progressive tax work. That is also how an IRA conversion works. It's as if you made an extra $100,000. So just treat it as ordinary income, no capital gains. The subsequent question, do I have to pay state income tax too? If the state of Virginia levies a state income tax, then yep, you're on the hook for that as well. Anyone converting, it doesn't matter what your cost basis is in a retirement account, has no bearing. Okay, good. Pamela writes, I was recently elected to the board of a 501c3 corporation. I'm serving on the finance committee. We are trying to find the best place to keep our reserve money. We would like to put 6 months worth of operating expenses, $300,000 to $400,000, in an account with earning potential. We're looking for something with low risk, very liquid, no fees. Some suggestions from committee members were to check out Fidelity, U.S. Bank, and Bank of America, and maybe put money in a money market fund or CDs. We also have a bank account at Chase that we use as an operating account. No interest being earned on that money. Ugh. And FDIC insurance is only $250,000. So we'd like to keep that account balance lower and have the option of transferring to and from an investment account as needed. Would you be able to suggest an investment company, or I think she means an investment, that would fit the description and a vehicle for the funds? So When I was doing some research for a nonprofit board on which I sit, I had a very similar goal. So, one thing that I found was a Vanguard short term treasury ETF. The symbol is VGSH. The other option that I found was a Fidelity fund, which was a short term treasury bond index fund. And that was the symbol FU, not FU, but FUM as in Mary, BX. So those were two that I found. I hope that is helpful to you and really appreciate you giving us a holler because that's a very common request that nonprofits have. They got to keep the money liquid. It's really important, especially if it's a part of your operating plan. You never know, right? If you've got a financial question and you want to run it by us, you never know. I might have a similar experience like I just did. So give us a holler. Ask Jill at jillonmoney.com. Ask Jill at jillonmoney.com. And if you want to subscribe to our sister broadcast, the podcast, just go to our website, jillonmoney.com. And Mark has put it right on the front door. You can subscribe to the podcast right there. So cool. All right, hang in there. Got another segment coming up shortly. You're back. It's Jill on Money. And before we finish out the program, we'd love to squeeze in one more question. This one is from Joy, who has the subject line, unexpected large capital gains last year, now paying all the credits back for the Affordable Care Act. Oh boy. Jill, how do you know what your capital gains and dividends will be so you can prepare yourself for taxes? I'm clueless here. Well, first of all, if you've got a big brokerage account that's taxable or an investment account at a mutual fund company, what you may want to do is pay attention to the transactions. Maybe you created your own capital gains problems. The dividends, you can look at what the past year has been for the distributions, but I don't know why you had unexpected large capital gains. That I'm not so sure. But generally, just look back to the prior year and try to avoid taking those big capital gains in a year where perhaps you might be able to limit it or wait until you're in a lower tax situation, lower taxable income situation. That's a tough one, huh, Mark? It's one of those nasty surprises to find out at the bitter end. All right, gang. We're going to finish up the show and remind you a couple of things. First of all, our music is composed by Joel Goodman. Mark Talercio is the executive producer and the best one in the whole world. And if you want to hear his voice, send us an email with your question and tell us you want to come on the air. And then you get to hear Mark's voice, which is amazing. Okay? It is May. It is springtime. You're going to get out. Many of you are vaccinated. Let's still be careful. Let's wash your hands, wear your masks if you need to, and maintain that physical distancing again if you need to. Just listen to what the guidance is from the scientists. It will help. Do something nice for someone else today. It will make that person feel better. It will make you feel better. We thank you so much for listening, and we hope to talk to you next week.